Hey guys, what's going on? Ron Sneller here. I'm here with my assistant Ashlyn, our full-time digital media coordinator. And today we're going to talk a little bit about retirement income planning, and we're going to go through a case study here. So if you guys, as you're watching this, if you guys have questions or comments, drop them in the comment section of the video, and Ashlyn will take those questions at the end. So we'll kind of go through a case study showing how we solve for retirement security. Showing people exactly when they can retire and exactly on how much income. And as you're watching this, again, if you're curious, if you have questions, you want to comment, or if you want to set a meeting with us, just go ahead and put a comment in the comment section, and Ashlyn will get any questions there at the end. So we're going to go through a client case study here, and we've changed the name of these clients to Jack and Jill. Want to protect their privacy. And when these clients came to meet with me, Jack was 63 and Jill was 64. Jill's a stay-at-home mom, and Jack's earning about $150,000 a year, and he wants to retire in 2 years. Now, their goal is to retire on $10,000 per month gross income. And so the first thing that we talked to them about is, as far as your guaranteed retirement income, we wanted to look at, first of all, Social Security. So Jack's Social Security is about $42,000 per year, and Jill's is about $20,000 per year based on her previous work early in her career when she was working. Then we asked them about pensions, and unfortunately, they don't have any pension income. You see point number 5 there. That's not surprising, seeing how pensions have gone extinct, kind of the way of the dinosaurs, right? So no pension income. So the next thing we need to do is kind of look at their income gaps. Yes.
You just need to go live on Instagram. You have to hit the go live button.
Oh, I hit the go live button, and I don't know what happened there. It's showing me that I'm live. It's showing that people have joined, so I think maybe Instagram, I think it's maybe just on a delay. So thank you. Going back to the income gap here. So it says that, again, their income goal is $10,000 per month gross. So it's $120,000 a year, right? And then when we look at their Social Security, you total those up, that's $62,000 a year. So just kind of keeping the math pretty easy, looking at the income gap, we have an income gap of $60,000 per year. Now, their asset base, they've built up to where they're almost at $1 million. And so this is a pretty simple mathematical equation. So if we need to create $60,000 of annual income from a $1 million portfolio, we can calculate the withdrawal rate necessary on that. And we can see that it's about 6%. So the math is nice and easy on that. So what are the financial risks that we identified for these folks, like going into retirement, right? So number one is longevity. And longevity is not just a risk, it's a risk multiplier of all the other risks, because the longer you live, the more likely it is that the market's going to crash. With the longer you live, the more likely it is that inflation is going to erode your purchasing power. And the longer you live, the more likely it is that you're going to run out of money, or that you're going to need long-term care, and all these different things, right? And so Jack and Jill are both relatively healthy. Their parents both live into their 80s, so it's likely that they'll live that long, or potentially even into their 90s. So we have to make sure that that money lasts and that they don't run out. Okay. Second thing that we identified when analyzing their plan is that they were taking on too much risk. They still had their investments position pretty aggressively, like they were 40 and trying to aggressively build up to the $1 million that they have right now. But when you are positioned for growth, that also puts you at risk. And seeing how Jack wants to retire 2 years from now and start taking retirement income, we don't want to be taking on all of that risk with all of the portfolio. Next up, point number 3 is that the withdrawal rate that they need to meet all of their income goals is way too high. At 6%, that's too high, and it's going to cause a pretty high probability that they're going to run out of money. And we'll talk about that a little bit more here in a sec. And again, that's just going to mean that we're going to move some of their money to more safer assets, to things that are going to provide some guaranteed income, to remove some of the strain from the investment portfolio to produce the income. But we don't want to get super duper conservative. We don't want to get so conservative that their money's never going to grow again. Because if you look at point number 4 there, we still have to battle inflation, and inflation eroding the purchasing power of their wealth over time. So we kind of have two competing goals there. Like, we're going to need some more safety, but we're also going to need to have enough growth potential to offset the effects of inflation. So let's go back to point number 3 here. So this is the big thing. In order to reach all of their income goals, they're going to need to withdraw 6% from their retirement, which is just way too high, right? We can pull up just an income chart right here, and we can look at withdrawal rates because the financial services industry has studied this. They've studied the rolling stock and bond market data all the way back to the 1920s. So we have over 100 years of data. And so we know that when you take a certain percentage of your portfolio throughout all the ups and downs of the market, we know at least historically what the probability of success is. And so when you retire, and if you were to take 4% of your retirement portfolio, you're going to have a 95% chance of success, meaning that in 95% of all market cycles that have ever happened, you didn't run out of money before you ran out of life. And that's looking at a 30-year retirement period, also with that income adjusted for inflation, meaning that if you had $1 million in your portfolio, you could take out $40,000 per year the first year of your retirement. And that would go up. That $40,000 would increase 3 to 4% each year for inflation. And then you could have that inflation adjusted spending throughout the course of your entire retirement. And that is what would keep you safe and give you a very high probability of success. Or if I was like your high school math teacher and I was giving out scores on a test or scores on your report card, like a 95% chance of retirement success means that you get an A on your retirement readiness report card, okay? If you increase that withdrawal rate and if you go up to 5%, your chance of retirement success drops, and it drops pretty drastically. It drops down to where you're only going to be successful 80 or 85% of the time. And so that's like a B or a B minus on your retirement report card, right? And you might say that you're okay with that, right? Like a B is not perfect. It's not quite an A, but it's not terrible, right? But then when you go up to 6%, and that's where Jack and Jill need to be at in order to accomplish all of their spending goals and accomplish their bucket list items, meaning all of their basic necessities, but also the lifestyle goals they have for themselves with their discretionary expenses and such. They need to be at 6%. And when you're at 6%, historically, your portfolio is going to fail and run out of money 60 to 70% of the time. So you're looking at, it's likely you're somewhere like at a D or a C minus at the very best on your retirement report card. And that's where we can kind of run into some problems, right? And the reason for that, because a lot of people get a little confused and they say, well, wait a second. If the market averages 8% over time, I should be able to take out 8% of my portfolio without even dipping into the principal. But the problem is the market doesn't go up 8% every year, right? It's all over the place. And can the market ever go down? I've got it pulled up on your screen right now. And yes, the market can go down. So just imagine what would happen if the market is going down, 50%, right? Like you see in the dot-com bubble here over on the left, the market's going down 50% and you're withdrawing 6 or 8% per year. What that means is that you're going to, your withdrawals out of your portfolio at 8% per year are going to accelerate that downward spiral on your portfolio and potentially send it into a death spiral where maybe you're never able to recover from that and you run out of money, right? So 8% is way too high. If you kind of like look back to this chart right here, 4% is considered safe. 5% is kind of like on the cusp, right? 6%, you're getting into really dangerous territory. The 7% or above, you're looking at maybe just a coin flip. Like half of the market cycles, you're going to be okay. Half the market cycles, you're going to run out of money. And which one of those are you going to be, right? Like you're basically getting an F on your retirement report card. And so when we put all of this information in for Jack and Jill and we use their Social Security and their current investment portfolio and stress tested it for a 30-year retirement horizon and factoring in inflation, they ended up having a 69% chance of success on their Monte Carlo simulation, right? So they had a D plus for their specific situation on their retirement report card. And obviously that's not something that they wanted to move forward with. And that's all I do when I meet with people. My first meeting is I'm just trying to learn about them and their goals or learning about me and my practice. And if it looks like we have a good fit, we move to the second meeting. And on the second meeting, what I do is I just analyze their current financial plan and their current portfolio and just kind of show them, hey, if you do not hire me and if you don't change a thing, this is likely how it's going to work if you just move forward with that. And I'm just looking to identify gaps or sometimes I identify things that are outright broken like this right here. And at the end of the second meeting, I simply just asked them, do you want me to fix this problem? And of course they said yes, right? So we went back to the lab, we started doing our analysis, started doing our research. And what we found is, again, to take $60,000 per year from a $1 million portfolio, that's just too much strain on the investment portfolio itself to produce the income. So what we need to do is we need to take some of those variable assets that are subject to market risk, and we need to shift them away from the market risk and shift them out of the market risk and move them to something safer that's going to guarantee lifetime income, but with no risk of market losses, right? So if we pull up our income for life report, which is this right here, and if we kind of look at, okay, so here's, what Jack's earning about $150,000 a year. He wants to retire in 2 years. We'll turn on his Social Security. We'll turn on Jill's Social Security. And if they take that 1 million investment portfolio, and if they're operating within that 4% safe withdrawal rate that we talked about, $1 million creates $40,000 per year of income. Total, they're at $102,000. But their goal is they want to be at $120,000, $125,000, right? They want to be around $10,000 a month gross income. So they're about $20,000 short or $25,000 short, right? So you want to look at that as about 15 to 20% short of what they want. And again, they don't have to do the 4% safe withdrawal rate. It's their money. They could do whatever they want. But again, if they go ahead and if they take 6%, which would be enough to meet all of their discretionary expenses, they're going to run a pretty high failure rate, right? So the solution here is really just to take this $1 million of investments and kind of split it into two separate buckets, right? We're going to keep some of the money invested in an IRA, right? But we're going to shift a portion of their money over into what's called a guaranteed income annuity, which is what I call the protected pension system. So we're shifting some of the money away from risk and putting it into a retirement insurance contract that's going to create a protected pension and is going to revolutionize and completely change the scenario here. But why would we use an annuity to get the job done here? Like, how does it help? So here's reasons that annuities work, right? Now, annuities are not investments. They're not accumulation tools. They're designed to create retirement income. And the reason that they work so well for retirement income is first bullet point that you see here, you cannot lose principal due to a market loss, right? And in Jack and Jill's scenario, since they're married, we put survivor benefits on there. So if Jack dies, Jill is going to receive that pension payout with a 100% spousal continuation benefit. So Jill's not going to lose this pension we're creating, and she's not going to see any decline to the income. Now, if they both die early, we also put survivor benefits on there for the kids. So any remaining principal and interest that they haven't spent from the annuity is going to be paid out at the time of death. Point number 4, and this is the big key here. Again, the reason why stocks and bonds, it's recommended to pace yourself with that 4% safe withdrawal rate is to pace yourself throughout all the ups and downs of the market. It's to mitigate for market volatility. But annuities are not investments. There's no volatility there. They're guaranteed retirement contracts, and you're basically just buying or funding your own personal pension. And that's why they work so well for creating retirement income, not for investment growth. We're not talking about growing wealth and trying to take on a bunch of risk. At this point, we're getting ready to retire. We want to protect some of our money, lock in our principal or take our profits off the table, however you want to look at it, and put it into a financial strategy or a financial instrument that's going to create very high income. So you see the 4% safe withdrawal rule for stocks and bonds, and usually with annuities, we're getting 6% or more. With these folks, it's going to be a lot more, and we'll show that to you. The income does continue for life. Again, this is a pension, right? We're creating a pension. It's guaranteed lifetime income. So that pension is going to pay them for life. Even if they set a world record for longevity, they live to age 120 or live to age 125, that pension payout is going to continue to come in like clockwork, right? Even if the account value goes down to zero, like maybe they live to 80 or 85 and they've spent all the principal in the annuity, their account value hits zero. As long as either Jack or Jill is still alive, that paycheck, that retirement pension paycheck is going to continue to come in like clockwork, regardless of how long they live and regardless of what happens in the market. Even if the stock market crashes 40%, this pension paycheck is going to continue unaffected. And that's what most retirees are looking for, is predictability with their income, security with their income. Because all of the research shows and all the surveys that a retiree's number one biggest fear is running out of money before they run out of life. And this is a way where even with the annuity, even if your account balance hit zero, and even if you ran out of money, you could never run out of income because that pension income is guaranteed for life. And that's what insurance companies do. The insurance companies are taking on that mortality risk through risk pooling, right? Now, the typical fees on these products range anywhere between 1 to 1.25%. And the pension payouts that we're going to show are going to be net after that annual fee is factored in. And then sometimes people are a little bit concerned with liquidity on annuities. Again, we're not using the annuities for liquidity. We're using them to create a protected pension and remove the strain on the investment portfolio to create the income. Now, there's still plenty of liquidity in the investment portfolio itself, but also in their emergency fund that's sitting in the bank. But if for some reason you needed to get access to the annuity, you could take 10% from that annuity account balance. So if you put $500,000 in there, a year from now, you could take out $50,000 if you wanted to. Now, what that's going to do is that's going to reduce the amount of the pension income that you're going to get for the rest of your life, which is why we never do this. I don't have any of my clients who would rely on their annuity for liquidity. We've got the liquidity built in other places, but some unforeseen emergency, you can get access to it. And so final point there, you would only pay surrender charges only if you were to withdraw over that allotted amount. Okay, so as we revamp Jack and Jill's retirement here, this is what it looks like now. So we've still got Jack retiring in 2 years. Nothing's changed there. Jack's Social Security is the same thing. Nothing's changed there. Jill's Social Security, same thing. Nothing's changed there. But here's the big change. So we took the $1 million portfolio, right? And we put half of it into the guaranteed income annuity. And then we left half of it invested in stocks and bonds. Now, based on Jack and Jill's age, the payout rates are based on the younger, and Jack is 63. He's moving the money over right now and establishing the account, but they're not going to retire for 2 years, and they're not going to turn on the income for 2 years. So in the industry, that's known as a 2-year deferral period. So for a 63-year-old with a 100% spousal continuation benefit and leaving on any lump sum balance to the kids on a 2-year deferral period, that pension payout rate ends up being a guaranteed 8.1% pension payout. Meaning when they turn that annuity on 2 years from now, it's going to be almost $41,000 per year on a guaranteed basis for the rest of Jack's life. And when Jack dies, if Jill's still alive, that pension income lasts for the rest of her life. And if they both die early before all $500,000 of principal is spent, any principal and interest that remains is going to go to their kids, okay? But look what this does. This pension amount right here that we're creating through this guaranteed income annuity, it's basically like adding in another Social Security payment. It's almost the same amount as Jack's Social Security. So what they're doing is they're bringing their guaranteed income base, which used to be $60,000 when you add up the two Social Security payments. Now we're bringing the guaranteed income base up to $100,000 per year. And so what that has done has removed the strain on the remaining investment portfolio to create the retirement income. Now we still have $500,000 left in stocks and bonds. Okay. Now remember, we talked about earlier, anything that's left in variable assets where there's volatility and there's market risk, we want to still operate within that 4% safe withdrawal range. Now the investment portfolio itself is only $500,000. That's still a good amount of money, though, to continue to build wealth and have inflation-adjusted income over time. But we're going to look at 4% of the $500,000 is $20,000 per year. But now their total income between the two Social Security payments, their investment portfolio, but this protected pension that we're now implementing, now that total income ends up being $123,000 per year. So they've got their $10,000 per month, and $100,000 of this annual income is coming from guaranteed lifetime income sources. The only thing that has market risk is the $500,000 in the investment portfolio, right? So this is how we solve for this problem and significantly increase the security and the certainty and the predictability of their retirement income. And then when we took this new scenario and put it into the Monte Carlo software, we can see that there is a 93% chance of retirement success. So bringing their retirement report card from a D plus up to an A. So this is absolutely incredible, guys. And I have never had more fun in my career than what I'm having right now. People coming to me and they know how much money they have. They're just not sure when they can retire or exactly how much it will produce for retirement income. Are we going to take out too much and run out of money? Or what if we don't take out enough and kind of cheat ourselves out of the retirement that we wish we had? This is an amazing way to do it, is create a protected pension and then have your investments on the side for inflation-adjusted spending as well. So thank you guys very much for tuning into this. I hope this was helpful. This is really just one easy, simple move right here. We'll kind of go into some of the questions that we have as well. Starting, and you can go ahead and drop your questions in the comments just on whatever social media platform that you're watching us on. One of the questions, though, that we get a lot is when we do this move from the investment portfolio over into the guaranteed income annuity, as we're moving that money, is that distribution taxable? And the answer to that is no. Because what we're doing, if we're moving money from a 401k or an IRA and we're moving it over, this move right here is actually classified as an IRA rollover. So it is not a taxable distribution. So this income annuity or this protected pension we're creating, this account, although it's with an insurance company, it is still an IRA. So there's no taxable distribution on that. The only taxable distribution is what happens is when you turn on the income and start receiving the distributions. So there is no tax to move the money. So that's a really good question that we often get. All right, let's stop sharing here and kind of come back. See if we can't put myself back up here. Ashlyn, are you aware of any other questions that have come in on any of the social media sites there? So I know that she's kind of checking that out and looking for us.
I do not see any.
Okay. One of the questions, I see one here on the StreamYard link. One of the questions that's coming in here, and we often get this a lot too, is why would you move money to the annuity a couple of years before retirement, and instead of kind of waiting like till the day of your retirement, so to speak? And there's really kind of two reasons for that. Number one is the best time to move money to an annuity is when the stock market is high. I have a lot of people I've seen in the past that want to use annuities as a stopgap when the market's going down. Like if you see a 10% correction, or even in 2022 where the market fell about 25% when it was at its worst, a lot of people will then try to use the annuity as a stopgap and kind of move that money to safety. But that's very reactionary, and when you do that, you're kind of locking in those losses. But that's investing for you. Most people kind of do it backwards. To make money in the market, what you want to do is you want to buy low and sell high, right? So when markets are at or near all-time highs, which is where they're at right now today, that's when you want to make that move. So you want to make that move to take your winnings off the table and lock in your profits, and then use those profits to buy that guaranteed pension or buy that high income. So that's rule number one, right? Or that's reason number one. The reason you'd want to do it a couple of years before retirement is because you want to have favorable market timing, so to speak. Because of the market, if you were to wait until last minute, but if the market were to go down 20 or 30% between now and then, you're going to be in a tough spot, right? So then the question is going to be, well, what do I do? Do I work a couple extra years and hope that the market recovers, right? Or do I just retire and then just pull way back on my standard of living and just not have the retirement lifestyle that we dreamed of? Right? You get in a tough spot. So you want to be proactive with this, right? And then the other thing has to do with those pension payout rates, right? So going back to that example with Jack and Jill, if Jack were to roll that money over right now, and if he were to turn on the income right now, that pension payout rate of 8.1%, it would drop way down. It'd probably be closer to 7%. That would be called an immediate annuity. If somebody were to roll the money over right now and turn on the income immediately, like if you were to wait till the last minute, 7% distribution rate, still good, but it's not 8.1, right? So by planning in advance and doing this a year or two in advance, you're able to like take your winnings off the table and lock in your profits when you know where the market's at, versus guessing where it might be 2 years from now or guessing where it might be 3 years from now. But that's the other thing, is the insurance company, the longer they have the money before you start the income, they're giving you these guaranteed interest credits, meaning that your pension is going to go higher, right? And you guys already have something like that, whether you know it or not. You already have something like that. It's called Social Security. And what I mean by that is like you're eligible for Social Security at age 62, but each year you delay, your pension income goes up about 7 to 8% each year you delay. So you could like look at your Social Security estimates and say, hey, my Social Security income at 62 is this, but if I wait and take it at 65, it's going to be this, right? And these annuity strategies that we use, they're very, very similar in that manner. Yep. So those are the reasons that you would want to roll your money over to an annuity beforehand, right? And that's what retirement planning is all about. You want to know what you're doing in advance. I have had people that have come to me and they say, hey, I want to retire later this year. What can we do? And some of those people, I tell them, look, I can't pull a magic rabbit out of my hat. Sometimes I say, hey, you're either going to have to pull back on your income expectations or you're going to have to work an extra year or two. And sometimes with people, I'm able to shift some stuff around, like we showed, like maybe we have to reduce the volatility of their portfolio. Maybe it's put money into a guaranteed income annuity to create additional pension income or create additional guaranteed income. And then a lot of times we're able to get it done for them. But the sooner you start your retirement planning, the better off you're going to be. All right. Anything else that we have there? Awesome. And then I guess one of the other questions that we get oftentimes is like, exactly how do you do this? And that is you want to work with a financial professional like myself to make sure that it's done correctly. And generally it's going to be done with like transfer paperwork to make sure that the 401k or the IRA is rolled over correctly and that it's not classified as a taxable distribution. right? Because you don't want to kind of screw that up and make it look like where you're just simply trying to move the money from one account over to another. You don't want to make it look like a withdrawal and have the taxes or potential penalties of that happening, right? Oh, we've got one coming in here, and someone says, I heard that annuities are bad and that you should stay away from them. And I laugh when I see stuff like that. And I would say that the quality of the advice that people get, you really want to look at, where does that advice come from? Nobody's out there talking about that except for people who their job is with a money management firm or like a Wall Street brokerage, like they're selling you stocks and bonds, right? So that advice is very biased. They're telling you that because annuities are competition for what they do, right? So you got to consider that. Now, I think, and all the academic research is very much in favor of annuities. I think Ashlyn can probably even put up some of the graphics here because we've got like plenty of the academic research. The academic research is overwhelmingly in favor of annuities. Here's one right here from Wade. No, that's not Wade Fowle. That's David Blanchett and Michael Finca, where it simply shows that retirees who have annuities actually spend about twice as much when they have these guaranteed income solutions. Right? Because if all the money you have is in stocks and bonds, people have a very hard time spending from their savings. They also have a very hard time managing or mitigating market volatility, right? And then they get into this, a lot of times they get into this dynamic of what if, or just in case, like what if the market crashes? What if I need long-term care? What if I live into my 90s? What if? And so they live this just in case retirement. And so they don't spend their money. And then they die. And then what happens to the money? The money goes to the kids, and the kids are the ones who end up spending the money. It's the kids who buy the boat, the kids who take the cruise. It's the kids who travel the world. And I don't want to see that. And I'm not against leaving your kids some money, but planning for your retirement, this is your retirement, your golden years, your dreams. I want to see you spend your money. Okay. And that's what having these guaranteed income solutions can do, is it allows you to know that that money's coming in like clockwork every single month for the rest of your life. No matter how long you live, no matter what happens in the stock market. So when that pension check comes in from your annuity, I want you to go out and spend it. You know why? Because it's coming in again next month. And I want you to go spend that one too. You know why? Because it's coming in again the month after that, regardless of what happens in the economy or with the stock market, or no matter how long you live, right? So it allows people to actually spend more money. So when we hear people say, "Oh, an advisor told me that annuities are bad," or that's because that's how they get compensated, is they're managing money. See, myself as an independent advisor, I manage money. I manage about $50 million of client assets, stocks, bonds, and securities, right? But I also implement these annuities, and we do life insurance. Like we do the whole kit and caboodle. We do the whole shebang, right? And that's where I don't have any firm that's like over my shoulder pushing sales quotas on me or pushing proprietary products that they want me to sell. I'm able to do the right thing for the client each and every time. And maybe that's a combination of investments and annuities and life insurance or whatever the case might be. But I'm able to take a holistic and independent, non-biased look at this and say, what is the right move for you based on your goals? Okay. Now, I think where annuities have gotten a little bit of a bad rep in the past has nothing to do with the product itself, nothing to do with the annuity itself, because the annuity is the best financial product for creating retirement income. So I don't know if Ashlyn, if you're able to find that that graphic where we have some retirement research on that from Michael Finca, but that's what they're good at, is they're good at replacing or creating the retirement income. Yeah, we have the study here by Michael Finca and Wade Fowle. So Michael Finca's on the left there. He is the professor of wealth management, like the lead professor over at the American College of Financial Services. Wade Fowle on the right, he's a lead professor of the retirement income. And so they show that annuities significantly enhance retirement outcomes. And that's why they've started including them in 401ks recently, right? And there's another one too by Michael Finca, if you're able to find that. Yeah, oh, nope, that's from JP Morgan Asset Management. Yeah, that one right there. He says, to an economist, an annuity is the most efficient way to create income in retirement. I mean, think about what we just showed there. When you have all your money invested in stocks and bonds, you're still taking on market risk. And in order to mitigate or manage that market risk, it's recommended that you take out 4% of the starting portfolio balance, otherwise known as a 4% safe withdrawal rule. But you saw that this annuity that we just got from my clients here, Jack and Jill, that annuity on a 2-year deferral period paid out a guaranteed 8.1% payout rate, right? So annuities are by far the most efficient and cost-effective tool at creating retirement income. Not for investment growth, not for liquidity, but for creating retirement income. So maybe the bad rep for annuities are been when they've had an annuity salesman put all of their money into an annuity or put too much of their money into an annuity where they don't have enough growth potential or where they don't have enough liquidity. That's where I think annuities can get a bad rep, but it's not because of the annuity itself. It's not because of the product. It's because of the way the product was implemented or the way that the product was sold. Okay. So as we kind of get to the end of this, I would just say that annuities are certainly not bad. As we just shown, they're the best vehicle for creating retirement income. They only become bad, or they only become that 4-letter word, is when they're not implemented in the correct way. So the point is, do not go out and just buy an annuity because somebody pitches it to you. You want to have somebody that's actually doing your retirement income planning, the comprehensive or holistic retirement income planning, Social Security timing, asking about your time horizon and how much income you need, and analyzing your current investments and how much money should go into the annuity in order to accomplish all of your goals, right? So you want to, if you're going to implement an annuity, do it through planning. Don't just go buy one because somebody pitched it to you, right? If they haven't done a deep dive on all of your financial background and all of your goals, definitely don't buy one from them. You want to make sure that it's implemented correctly alongside your stocks and bonds and other financial products that you have, right? So that's what I would say on that. All right, so I think we've been going about half an hour now, which is actually longer than I expected this live stream to go, but really great comment, guys. Let me put up my website and phone number here. Again, guys, if you are interested in visiting with me on this, you can go to my website, snellerfinancial.com. We have our scheduling tool right on the website. We work with clients in more than 40 states, and that's a really good thing for you because you can get personalized financial advice from a professional who specializes in retirement income planning, and you can get that advice from the comfort of your own home. Now, we teach classes, we teach Social Security seminars, we do retirement investing classes in our area. People come into the office here, local, like Metro Detroit area. But I know that's a very intimidating thing for people. And I know that a lot of people don't go get the advice they need just because they feel unprepared, or maybe they feel like they don't have enough, or maybe they feel like they're embarrassed and they don't want to walk into a financial advisor's office. So working with me over Zoom is an awesome way to analyze your situation, to put a great plan into place, but do it also from the comfort of your own home. So we've got clients in more than 40 states. So if you are like remote from me and you're not in the Metro Detroit area, don't let that be a deterrent to working with you. You can still go over to my website and book a complimentary consultation. You can also check out our Google reviews. I want to say we have about 80 Google reviews. We've got more than 200 clients, spread like out of state. And a lot of them have left us Google reviews as well. So you're able to kind of check out like us working with people and their experience with this process too. So you can also call the office. You can call the office and talk to Peyton and schedule your appointment that way. 248-499-9676. You can get a hold of us there. Peyton will be happy to schedule the appointment and kind of let you know what you need, what you need to bring to the meeting, how to prepare. Now, obviously, if you are in the Metro Detroit area, we'd love to see you in office, but most people watching this are obviously going to be spread out. So she'll let you kind of know like what you need. And if you do book an appointment on the website, just using our scheduling tool, Peyton's still going to reach out to you and let you know like, hey, this is the information that you need to collect for this first conversation with Ron, so we can have a really good conversation. And just so you know kind of what to expect. When we meet on that first meeting, we are never doing business on a first meeting. I know that a lot of people, they see my content, they want to meet with me, but it's like, oh my gosh, am I going to get this high pressure sales pitch from the guy who's going to ask me to move over my entire life savings to him after talking to him for half an hour? And the answer is no. The first meeting is a discovery call that usually lasts about an hour. I'm learning about you and your family and about your goals and about your financial situation. And you're learning about me and how I do things in my practice and how I'm compensated and all these different things. And when we get to the end of the first meeting, if it looks like it's a good fit, you like me and I like you and I think I can help, what we do then is we schedule a second meeting for 2 weeks out. You're going to send over your Social Security estimates. You're going to send over your account statements. I'm going to analyze everything and come back to you on that second meeting and review your current situation. And I would say maybe 2 times out of 10, there's not a lot I can do for people. Like people are in a pretty good spot, right? So you might already have a plan. You're not sure if it's good. Like maybe you want to get a second opinion. And every once in a while I come back and say, hey, you're in a great spot. Your advisor's doing a great job. Don't ever leave him. If he retires, call me, right? But I would say probably 7 times out of 10, maybe 8 times out of 10, I'm able to identify significant gaps where we need to fix those things. Sometimes people, their plan is outright broken. I mean, I've had Monte Carlo simulations come in where the retirement success score is going to be a 40%. And that's real bad, right? Like taking on way too much risk, or their mutual funds are just way too high of fees and they're not performing, or just, there's a lot of different things that we find. So the second meeting, again, we're analyzing your situation, identifying things that I think are risks and I think need to be fixed. But at the end of the day, it's your money. So when we get to the end of the second meeting, at that point, I'm simply asking you, do you want me to fix it? And if the answer is yes, we're going to set up a third meeting. And I might, at the end of the second meeting, I might briefly review it, like what I have in mind. Like, hey, this is how I think we'll shift the investment portfolio. And if we're going to use an annuity, like I'm thinking it'll probably be this much. I won't know for sure. But on that third meeting, between the second and third meeting, that's where I'm doing all of my research. Exactly how are we going to fix these problems? How are we going to fill in the gaps? How are we going to fix what's broken? And then on the third meeting, that's where I'll review your personalized financial plan, exactly what we need to do to fix those problems and secure the retirement of your dreams. And then when we get to the end of the third meeting, I present your best interest solution. I'm still not going to ask you to move your money, right? Because it's a big situation, and you might be 90% of the way there, maybe 99% of the way there. And I'm going to tell you, still sleep on it. Right? Let's set up a meeting for, next week. We'll plan on filling out the paperwork, but if any questions pop up, bring them to that meeting, and we're not going to fill out any paperwork. We're not going to fill out any money until all your questions are answered to your satisfaction. So my client onboarding process, generally we're doing paperwork on the fourth meeting. Or if you have a very, very simplistic situation, it might be the third, but it's usually like on the fourth. So that's like a weekly meeting over the course of a month, or bi-weekly meetings over the course of 2 months, right? So that's kind of how the process works, and hopefully that's helpful. Ashlyn, do we have anything else? Because I have the gift of gab, I can keep on going. All right, awesome. So guys, again, thank you for tuning in. I really hope that this was helpful. If there's anything that you need, do not hesitate to reach out. Whatever social media platform you're watching this on, make sure that you're following me. Make sure that you're engaging with the content, asking questions, or sending me direct messages. Again, if you want to schedule an appointment, go to my website, snellerfinancial.com. You can use a scheduling tool there to schedule your own appointment, or you can call me over at the office, talk to Peyton, 248-499-9676. And while I do have a team at the office, I have 4 full-time support staff. I am the only advisor. I'm not ditching you off on somebody else. You'll be meeting with me, and I'm going to be your advisor all the way through the entire way. So just so you guys know that too. That's another question we get. Am I actually meeting with you, or is it going to be somebody else from your team? Like, I have support staff that are on the meetings, keeping me organized, helping me take notes, stuff like that. But I'm the advisor and the wealth manager or money manager. Okay, great. Thank you guys so much. Hope you have a great day, and we will talk to you later. See ya.